14 years. That's how long these Bitcoin coins didn't move. Since 2009, and then suddenly 10,000 BTC started moving. Coins minted in the Satoshi era, untouched through every bull market, every crash, every headline, were sent to exchanges in October. At the time, that was over 1 billion worth of Bitcoin. And within days, the conclusion across social media was immediate. Bitcoin is over. Smart money is exiting. This is the top. But here's what almost nobody bothered to check. This wallet didn't dump everything in one go. It distributed slowly over weeks, and wallets like this have been doing that on and off for years. According to on-chain data tracked by Glassnode and CryptoQuant, Satoshi-era coins have been gradually declining since 2018, accelerating during period of institutional liquidity. Not panic. That matters because this is not fear selling. This is liquidity-driven rotation. And to understand why, you need to stop thinking of Bitcoin as a startup and start thinking of it as a public asset. Bitcoin never had an IPO. But structurally, what we've seen over the past 4 months looks exactly like one. Early insiders distributing supply into deep regulated liquidity. While institutions absorbed it quietly since January, US spot Bitcoin ETFs led by BlackRock's IBIT, Fidelity's FBTC and ARKB have absorbed hundreds of thousands of BTC. On multiple days, ETF inflows exceeded $700 million, even while price was flat or falling. That's the key signal. Price down, demand up. That's not a distribution. That's ownership transfer. Now, let's address the old institutional objections to Bitcoin, because this is where the story really changes. First, volatility. Bitcoin's realized volatility has now fallen into 30 to 35% range, according to Derbit and CME data, levels that were unthinkable 5 years ago. Second, yes, early ownership was skewed, but every month ETF issuance spreads Bitcoin across pensions, endowments, RIA, and sovereign-linked funds. BlackRock doesn't buy headlines, they buy structure. Bitcoin is no longer trading tick for tick with the Nasdaq. It's not tracking gold either. Lower correlation is exactly what portfolio theory wants. This is why institutions didn't leave during the drawdown. They added. Now zoom out to macro, because this is where most retail narrative completely fall apart. Liquidity wasn't tight most of the year. Rates stayed restrictive, and yet Bitcoin is still up years to date. More importantly, on-chain data shows Bitcoin recently moved from net realized losses back into net realized profit. A transition that has marked recoveries from local bottoms multiple times since 2022. This phase feels boring, sideways, emotionless. That's usually when accumulation is happening. Markets don't top when participation is selective. They top when everyone feels smart. Now, let's talk about Ethereum, because this is where the next wave of misunderstanding is forming. Over the past week, Ethereum averaged 300,000 to 400,000 new wallets per day, the highest growth rate in its history. One single day printed nearly 400,000 new addresses. At the same time, fees dropped after recent upgrades. Layer 2 transaction costs fell below $0.01. Stablecoin settlement on Ethereum exceeded 1 trillion in Q4 alone. That tells us something critical. This isn't speculation. This is infrastructure usage. Over 70% of global stablecoins value now settles on Ethereum. Major tokenized real-world assets, US treasuries, funds, and credit products are being used primarily on Ethereum. According to industry data, more than 12 billion in real-world assets are already live, and institutions are positioned. ETH ETFs, corporate treasuries, and structured products now hold tens of billions of dollars worth of ETH. This isn't retail hype. This is Wall Street building rails. And macro liquidity is starting to turn. In recent weeks, the Federal Reserve has quietly injected tens of billions of dollars into markets via balance sheet operations. Not rate cut, not QE headlines, direct liquidity. Historically, risk assets respond after positioning is complete. Not when headlines hit, and unlike gold in 2004, Bitcoin's supply cannot expand. Gold ETFs launched, miners increased output, Bitcoin ETFs launched, and supply keeps shrinking. The next halving reduces issuance again. This is why comparison to gold matters. Gold's ETF launch led to years of consolidation, followed by structural melt-up. Bitcoin is following the same institutionalizing curve, but with harder supply constraints. Could we still see volatility? Yes, regulation delays, Fed communications, political noise, short-term disruption are possible, but structurally nothing is broken. Bitcoin is now a multi-trillion-dollar asset. Ethereum is becoming settlement infrastructure. Institutions are already inside. This phase isn't exciting, it's not loud, and it doesn't reward impatience. But it's exactly how major transactions happen. The people who confuse boredom with weaknesses will sell too early. The people who understand structure won't. Thanks for watching, and I'll see you in the next one.